Martin Gilbert, the Standard Life Aberdeen co-CEO. Of course, Standard Life Aberdeen just reporting numbers and also reporting a deal and some director-level changes. Martin, very good to speak to you this morning. Good to have you on the programme. Yeah. Let's have a word then about this deal you've done. What's the rationale? Why are you making this sale at the moment?
Well, I think we felt that Phoenix was a more natural owner of the life company. It's a capital-heavy business. Our model is a more capital-light model. I think it's great news for the people at Standard Life, the customers, and of course our shareholders. We felt that this was a better route to go for our people.
Tell me a little bit about the underlying business then. I see that you've reported full-year net outflows, £31 billion, Martin, for Standard Life Aberdeen. Tell us about the most recent trends then in outflows. We've seen the Lloyds Banking Group news, of course, but what is the underlying outflows performance for you at the moment?
Yeah, it's better. I mean, obviously 2017 was better than 2016. We feel that we're making progress, and one of the advantages of the transaction with Phoenix is we're keeping the very high growth platforms, and as you've seen, the flows there were good last year. They've been growing at a compound annual growth rate of 35% a year. So this gives us a chance to invest further in the platform business, where we see huge growth in the future.
Apart from the sizable news around Lloyds, the other outflow trends, is 2018 looking better than last year, Martin?
Yeah, well, it's too early to tell. We're just a month in, but yeah, apart from the Lloyds amount, it is looking better. We've integrated the two distribution teams, so they're going forward with starting from 1st January rather than halfway through the year. So yeah, we're definitely seeing better trends. I mean, clients globally understand that you either need to be big in this business or small. So certainly the structure now lends itself more to a modern capital light investment company.
You've said recently, Martin, that you're not interested in doing M&A deals. You've got your hands, you're busy enough, which I understand, with the Standard Life and Aberdeen integration. Does what we heard about Lloyds, does that change that? If you've still got these scale aspirations, does the Lloyds news change your M&A aspirations?
Well, no, I don't think so. I mean, I think, look, we have more than enough on our plate. The integration of these two asset management businesses, now the separation of the platforms from the life company. We've got a lot going on. I mean, clearly Lloyds was unfortunate, but not all is lost there, I think. So let's wait and see. But I think we've been working non-stop for the last year, I think, and really working on restructuring the group, and as I say, the sale of Standard Life to the merger, I would say, of Standard Life into Phoenix was probably the final step in that transformation.
You say not all is lost, Martin, on the Lloyds side of things. Is that because you hope to win the business back, or you've got other options? Why do you make that comment?
Well, I think just, we've still got a very good relationship with Lloyds. The two businesses are deeply embedded within each other, and performance has been very good, as they said in their press release, and we've said. So, I mean, as I say, let's just see what happens. As you know, one of the reasons they gave for serving notice on the contracts is competing with Scottish Widows. So let's just see what happens in the future. But it's in their hands, not our hands. So we hope that the good performance might help us in the future.
Do you think, Martin, you'll have to revisit any of the synergy targets that you talked about when you did your recent Standard Life deal? You talked about $200 billion pounds worth of synergy benefits within 3 years. Does the Lloyd's news, does that change those synergies? Do they need to be revisited?
No, a lot of the synergies were already in the system. So today we've announced we've revisited the 200 million, and we've raised that to 250 million. So we were naturally looking at the business and where there was overlap. But as I say, both these transactions are not about cost cutting, but are about building businesses. And certainly as far as Standard Life's concerned, the merger with Phoenix creates Europe's largest back book consolidator, so is very good for our people and customers of both businesses.
In terms of markets and what we're seeing at the moment then, Martin, obviously the move from active management into passive management by some investors is something we've talked about in the past. The return of volatility, if that's what we've seen in February, is that going to change that assessment, do you think, for investors? Do you think investors will be more interested in active management after the return of volatility?
Yeah, we're certainly seeing that. I mean, the volatility really helps active management because it gives you a better chance, shall we say, of outperforming the benchmark. And that's been the problem over the last few years. It's been better to be in the benchmark than a large number of active managers. So certainly I'm pleased to see the return of volatility, because also it's rid us of the complacency that I was so worried about, and really feels a better market for active fund managers.
Is that volatility here to stay, do you think, Martin?
I have no idea, but I think what we don't want is that very low volatility we saw over the last period. So a bit more volatility definitely helps active fund managers.